David Reger's company Robotics used to produce in China, but then concerns over intellectual property and the fact that most of its suppliers were already in Europe compelled to move back to Germany.
So it was kind of difficult there. And that's why in Germany I think it's just more structured.
Reger isn't the only one questioning ties to China. Big companies like IBM and Apple are reducing their footprints. Mitsubishi announced an end to its joint venture in the country, and pressure is growing for other car makers to do the same. There's also evidence that smaller companies are rethinking their investments. Is the risk of operating in China beginning to outweigh the reward? That's the message now coming from a large group of European firms. This week, the European Chamber of Commerce in China, which represents more than 1,700 companies active in China, warned that patience is running thin. Specifically, the report said that, quote, a sentiment is emerging at company headquarters and among shareholders that the returns on China investments are no longer commensurate with the risks faced. That language is a shift. Foreign firms have complained for years about the same issues in China: restricted market access, intellectual property issues, vague investment rules. But the upside always outweighed those issues: more profit. We're going to look at what's changed. We'll talk about the economic headwinds China is facing. We'll look at how politics is beginning to trump business, how Beijing's new push for advanced manufacturing is heating up competition inside the country, and we'll ask what this all means going forward. Profits are down in China, and that's the fundamental problem for foreign firms. That's clear from the headlines alone. Bigger businesses are reporting weaker earnings. But we're also seeing weaker earnings among smaller, non-listed firms. For example, in a survey of European companies published this year, 2/3 reported that their profits in China for 2023 were either equal to or below their average globally. That's the lowest proportion in 8 years. Now, maybe it doesn't sound so bad if profits in China have merely fallen back to earth, but consider how good they've been in the past few years. Companies have come to expect solid results. Volkswagen, for example, has relied on China for more than 1/3 of its overall revenues in recent years. Now business is just trending towards bad. According to one survey, more than 2/3 of European companies say business became more difficult in 2023. The reason why China isn't buying, from consumer to luxury goods, is that the economy is still struggling. China has yet to really recover from the pandemic. Global demand for its goods has been slow to return, but there are also domestic factors weighing down the economy. Unemployment has risen among youth, debt levels remain very high, and a collapsing property market has undermined many households' wealth and savings. All of this has darkened the mood in the country to spend. Add to that a dimming long-term outlook. You may have heard about China's demographic problems. Its population has declined for the past 2 years, and the country's high ratio of elderly to youth is going to be a burden for future generations, requiring even more spending down the road. That, and fewer births, imperils future economic growth, which means that the long-term outlook for China isn't as bright as it once was. By comparison, other markets around the world look somewhat better. The US and India in particular stand out. Both economies emerged from the pandemic with more momentum, and both appear headed in a more positive direction. Again, the fact that profits in China are comparable to other markets may not seem so bad at first, but it does shift the risk-reward calculation for many businesses. As I mentioned, companies were already facing certain problems, unequal market access for one, but other risks have become more pronounced in recent years, often at the expense of his economy. He clipped the wings of the country's rising tech sector and put its CEOs in their places. He's pushed for more national production and the consumption of Chinese-made products. And he's overseen trade spats along nationalist lines, for example with Australia, where China ended wine imports following a political spat. Xi has also made social control an important focus. He's tightened censorship and cracked down on critical voices online. In Hong Kong, he ushered in security crackdowns. And he's passed a new espionage law with vague definitions of illegal activity. He's also increased saber rattling against Taiwan. All of these measures are problematic for foreign businesses. Overall, Chinese nationalism is becoming a bigger problem for many companies. Remember the uproar over cotton out of Xinjiang? That's the western province of China where the UN has established that forced labor has taken place. Companies operating in China must now essentially choose which side of the issue they're on. Continue using materials out of Xinjiang, and you'll run afoul of governments and human rights activists, especially in the West. Agree to stop using those supplies, and you'll run afoul of Beijing, risking one of your biggest markets. Now imagine the same dilemma after an invasion of Taiwan. But it's not just social and geopolitical issues where Beijing politics come to bear. Basic economic data is becoming harder to share and publish in the country. Beijing, for example, stopped publishing youth unemployment numbers for 6 months after that data continued to worsen. In August, it stopped providing the daily flows of foreign funds into domestic stocks after those numbers turned and stayed negative. In other words, more investors were pulling money out than putting it in. If that doesn't seem like such a big deal, consider this. Investors, domestic and foreign, rely on such data to make decisions about their future investments. If they can't trust the data, then that's a problem. And it only adds to an environment where economic reality is being buried under a guise. For a country that needs more outside investment, that is indeed a problem. You may think of the car industry when you think of Chinese firms now competing with the West. It's a good example. Foreign car makers did well in China for decades. Now they're facing stiff competition in China and outside from Chinese companies that have received help from Beijing, from cheap capital injections to cushy land deals and other subsidies. But the car sector isn't alone. China's new focus on advanced manufacturing, from cars to chips and machinery, is hitting many sectors. And it puts foreign firms in China in a particular bind. Take the machine industry. Machine makers across Europe benefited from China's export boom in the 2000s. They're the ones who outfitted the factory floors, sending machine tools, die casting equipment, or textile weaving machines. Now Chinese manufacturers are producing more of those machines domestically. That eats into the market share of traditional exporters in the country, including countries like Germany and Italy. And it makes the market much more difficult for them. And there's another kink. Just consider weaving machines. Chinese manufacturers are now producing so much that they're exporting the machines, meaning that traditional exporters, again, such as Germany and Italy, are now competing with one of their biggest customers in other markets. Now, they could ask the EU to intervene, much as it has in the car industry, and put tariffs on Chinese machines entering the EU for whatever that's worth. But then they risk blowback from Beijing, and many companies are still heavily dependent on Chinese sales, even if they are losing market share. In a recent policy paper, Germany's Machine Industry Association warned firms that in some cases, turning to political measures against Beijing might actually mean giving up the Chinese market altogether. Well, we're already seeing where all this is leading. Take a look at this next graphic. It shows that German investment in China has paradoxically increased in recent years. But actually, it turns out that most of that is reinvested profits from those China operations. Major foreign direct investments, greenfield projects, have meanwhile been falling in China. In other words, more companies are walling off their Chinese operations instead of investing in new ones. And while they're not flooding out of the country, they're increasingly looking at their options. Take a listen to Jens Eskelund. He's president of the European Chamber of Commerce in China, which released that policy paper that we mentioned earlier.
It's no longer a given that foreign direct investment will simply flow into China at very elevated levels.
There are, of course, challenges to a shift away from China. China has good infrastructure and experienced labor, and it's still a massive consumer market, even if the shine is beginning to wear off. And that's pretty much the point. A China that's changing economically, demographically, and politically appears to be moving away from what it once was, a sure bet.